This is Andrew Stotz of Stotz Investment Research to talk about our valuation model. In this case, we're looking at the company Malee Group Public Company Limited in Thailand. First, a disclaimer. This example was created on the 23rd of January 2017. What follows is not a valuation, forecast, rating, or recommendation. Rather, it's a teaching example. What follows is not investment advice. Rather, it's a teaching example. It is intended only as academic information to those who want to learn about valuation. It should not be construed as the basis for any valuation or investment. The information in this presentation came from various sources which we believe are reliable, though we do not guarantee the accuracy, adequacy, or completeness of such information. I hope you enjoyed learning about valuation as much as I do. So let's get on with it. Malee. Malee Group Public Company Limited was founded in 1964 and produces and distributes its products for domestic and overseas markets. In fact, as a beginning analyst in 1993 and 1994, I actually covered this company. It is engaged in manufacturing canned food, beverages, vegetables, and meat under Malee, First Choice, Hunter, and Farmer brand names. It holds about a 25% market share in the premium fruit juice market in Thailand. The products under the Malee brand are divided into two groups: beverage products, which are juices, coffee, water, and milk, and processed food, fruits, and refreshments, which are canned fruits, sweet corn, and ready-made refreshments. The company also does contract manufacturing, producing goods in accordance with customers' requirements under their brands. And they've recently announced a 49-51% JV with Mega Life Sciences, which aims to develop scientifically proven natural food and beverage products for the domestic and overseas market. So the revenue by segment as of 9 months is their own brands, 55%, and contract manufacturing, 45%. And 57% of the sales breakdown are domestic sales. So now let's get into the forecasting. Of course, when you value any company, you've got to make a forecast. So let's give it a go and see what we can come up with. What you can see is the historic period and the discrete period. Actually, 2016 is part of the historic period, even though we're still forecasting it, because we don't do the valuation off of 2016. We do it off of 2017 numbers. So that's why we call that the discrete period. The company's got about a, let's say, 7 to 8% growth, and what we can see, so if we look at the growth right here, we can see that. And then net profit margin has come up from 6 to 8, and we're going to keep it at about 8 to 9. So the company's profitability is good over the next couple of years is what we're assuming. Now, the next thing that we can see is that the company is growing its net fixed assets recently, but that will slow down a bit over time. And the revenue per assets went from 176 up to 211. Then we expect that that will fall a bit over time, but not by that much. So the next thing that we want to look at is the balance sheet on the liability side. That was the asset side before. And what we can see is that the company's payables is about roughly 40 days, and we're going to keep it that way. And a small amount we can see up here in the long-term borrowing section, very small, so let's just keep a little growth right there. Dividend payout ratio about 50%. So now if we move on to the cash flow statement, what does all this mean? Well, we can see that cash flow has been strong, and we expect it to be stronger going forward. And overall, operating cash flow to sales has been about 8 roughly, and we assume, as we saw, that profitability was rising. That number tends to rise when profitability is rising, so that's operating cash as a percent of sales. So now let's take that forecast and go through our valuation process. So the first thing we want to do is understand the free cash flow that implies. We can see that the company's earnings before interest and taxes here, then we take away taxes and we get net operating profit after tax. So we can see that number growing, and then here we go into the fade period. Now, what really matters is the amount of depreciation, capex, and the like, and we can see that numbers right here, and capex slowing down as we saw fixed assets slowing a bit, And so the end result is, this is the number we really want to look at, which is free cash flow to the firm. And what we can see from that free cash flow to the firm is a bit sporadic growth, which free cash flow tends to be. And why is that? Well, mainly that's because the working capital tends to be a little bit sporadic. But from that, we can see a pretty strong free cash flow to the firm growth, particularly in the discrete period, where we can see it's about 25 to 30%. Now, we also want to look at the invested capital that the company has and the growth in that invested capital. And we can include cash in that, or we can exclude it in that. And what we can see is that growth in invested capital, 5 to 10%. And basically what we can see then is the return on invested capital is about 25%, so not bad. And then the fade period is where we're fading down the profitability to go back to normal. So now let's look at the final thing, which is the per share data that we need for the dividend discount model. And so we start with the EPS. The company's been growing its EPS very strong. We can see particularly about a 70% growth. So with that strong of a growth, it's unlikely that they're going to get that again in another year. So we're going to keep growth relatively stable. And also what we can see is that the payout ratio is stable at about 50. So that means that the growth in dividend is going to match the growth in EPS. So those two are generally going to match if dividend payout ratio stays the same. So now let's move on to the cost of capital. And we can see the first thing is that for Thailand, we assume a risk-free rate of about 4%. And what we look at here next is the market premium or the market return about 12, which would give a market premium of about 8%. Those are the numbers that we're assuming for Thailand. Of course, those could be very wrong or they could change. But let's use that across all the companies. And I think the important thing is that these things stay the same by country, depending on what your forecast is or your expectations are. Now, the next thing we can do is look at the beta over a 3-year, 5-year, or 10-year period. And we can see it's a low to moderate beta stock. So therefore, we use 0.75. 0.75 is kind of our go-to number if it's a low. And this is based upon research that we've done about the convergence or the reversion to the mean or the reversion of high or low beta stocks. So we try to keep it in a tight range around 1. That gives us a required rate of return of about 10%. Now, the company basically funds almost all of its capital structure through equity. So the weighted average cost of capital is almost equal to the cost of equity because the level of debt is very, very low. So now let's talk about terminal growth. The assumption that we've got is about 3%. Our final discrete year is 2021, and we can see that final discrete year right here in this chart. And we have a fade period where we're fading down of 5 years. So that fade period is this, as we can see, this red line right here. And then we can look at our final growth levels in that case. Now, we also use multipliers. This is the multiplier that we use for the Gordon growth or the constant growth model for the terminal period, which is about 14 to 15 times. And that's how we get the terminal value, which is based upon this going forward. So, and then finally, let's move on to the valuation that we get from that. And you can see DDM valuation. Remember, there are 3 components to this. This is our discrete period where we're forecasting. This is our fade period, and then the terminal value. And we can see that about 23% on dividend discount model comes from this discrete period that we are forecasting. Then the fade is about 21, and then 56% coming from terminal value. Now, many analysts will look at these two the same. In other words, they may forecast for 5 years, and then they just do a terminal value. So we could say that 23% is in the discrete period, and roughly 7% is in the terminal period. We like to do the fade period because that just gives us a more accurate number. Now we can see when we do the free cash flow to the firm and free cash flow to equity, it changes a bit where we see 17% and then down to 13% in the discrete period. The end result after we've added back cash and we've taken away debt in particular, and what we end up with is the equity value per share right here, which we can see in every case is much lower than the market price. So it would appear from this that the company is, the share price has a lot of optimism in it, unless we are wrong in our forecast and valuation. Now, let's look at the valuation relative to the consumer sector. And what we can see here is the PE ratio is about 24, 21 times. That's about in line with Thailand. And it's about in line, a little bit more expensive than Asia ex-Japan and a little bit more expensive than the world. Then it's a question of what level of growth. So if we're paying 24 times in PE, what level of growth do we get? Well, that growth's not huge right here, but it does start to get big over here. So when we look at this, we can see on the upper left that lower is cheaper. And so this company is higher than almost every, whether we're looking at consumer staples sector in Thailand, Asia, ex-Japan, or the world. And if we look at it over here, we can see that the price to book ratio is pretty high relative to Thailand. However, what we can also see is ROE is very high relative to Thailand and Asia, ex-Japan. So yes, it's still expensive a bit relative when we look relative to Asia or to the world. But relative to Thailand, we can say it's a little bit cheap, not by much. So when we look at it from a free cash flow basis, we can see that it looks to be expensive. And then when we look from this basis, it's basically a little bit expensive or possibly only slightly cheap or in line with the market. Finally, let's just look at the 4 sensitivities that we should look at. Sales, gross margin, discount rate, and terminal growth rate. And from this, what we can see, let's just focus in on this one right here, and we can see that the sensitivity to the gross margin is where you get the biggest bang for your buck. If the company was able to move its gross margin from 34 to 39 by increasing it by 5 percentage points, that would cause EPS to go from 21 to 31.8. But if the company saw that its gross margin fell, in this case, let's say to 29, 5 percentage points, that's going to bring the EPS down to 12.5. So a lot of sensitivity there. And then we can also see that the impact of that in the valuation, the right side of this, which is the valuation section, we can see that there's a lot of sensitivity on the free cash flow to the firm and free cash flow to equity. So that wraps it up for Malee, and you can get a picture that the company appears to be a little bit expensive. So you got any questions? Just leave a comment and I'll try to answer it. Have a great day.